Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. We also have with us today Corby McGordon, who's my business partner at Ennis Legacy Partners. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then planning for your eventual exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. When an owner sells their business, they always need to be aware of what taxes they're going to be required to pay as a result of the sale. And every owner we've ever dealt with, at least every owner that I can remember, that we've ever dealt with, has wanted to minimize taxes, take every step they can to pay the least amount of taxes as possible. So that's one issue, of course, you're going to need to be aware of when selling. There are a lot of issues, but when it comes to the actual payout, that's a key piece, taxation. Another issue to be aware of often is any potential risk in receiving future payments in a transaction that involves any kind of installment sale. And today we're going to discuss what could be a possible solution if you're considering a sale currently and have one of those concerns and maybe even other concerns. So the pros and cons of structured installment sales is our topic today. And our guest is Steve Pilger, National Sales Director of Structured Settlements for Ash Brokerage. And Steve has 35 years of experience in financial services industry and provides comprehensive settlement planning solutions to the clients of their nationwide advisor network. Cases that Steve works on involve physical injury claims as well as non-injury situations, like a sale of a closely held business, that may utilize a structure including attorney fee deferrals and structured installment sales. Steve's a registered settlement planner, a certified structured settlement consultant, and a retirement income certified professional. And we're very excited to have him with us here this morning on the podcast. Steve, good morning and welcome.
Good morning. Thank you all for having me on today. Look forward to it.
Well, Steve, thanks for joining us. Let me start off. So my one experience in 40 years, my one experience with a structured settlement was we had a client who was buying out his partner from a group of real estate partnerships. Mm-hmm. And kind of at the last minute, the partner came forward and said, well, here's now who you're really buying them from. So, my client who was selling got a little freaked out. And I said, well, I don't think you care. You're the one selling. You kind of want to know if it was legitimate. So, it certainly appears legitimate. I'm sure it is. But from my understanding, the guy who was selling, since an installment sale wasn't on the books, this was a way for him to, in effect, get the tax benefits of an installment sale without giving up the ability to control the funds. Is that the gist of it, or am I misstating that?
There's a gist of it, but Walter, I think what you uncovered is one of the words of advice, or first words of advice, that we have for clients considering a structured installment sale. By clients, buyer and seller, and I know we'll kind of cover that as our time together unfolds. But the earlier in the sales negotiation process, seller decides or maybe is considering utilizing a structured installment sale, as part of the distribution of the proceeds of the pending sale, the sooner they can bring that to the attention of buyers or potential buyers, it's one less hurdle that we often find comes up at the end if something supposedly gets dropped on one party or the other that maybe wasn't part of the negotiations up to that point.
Yeah, it spooks them a little bit. Yeah,
it certainly does, and rightfully so, because it is a change, and literally an addendum that is attached to whatever purchase and sale agreement that buyer and seller have.
Okay.
Hey, Steve, why don't you, here at the outset, just describe what a structured installment sale is?
Okay, yeah, best place to start. Installment sales, just as a concept and as a practice, have been around for many, many years. In the tax code, section 453 outlines what an installment sale is, what can qualify. There's plenty of literature, information, and tax code that covers installment sales. The work that I do for our clients adds one piece to what otherwise would be a traditional installment sale, which is buyer and seller agree on the details of a purchase and sale of a piece of property or a business. And included in that is an installment agreement. So instead of the buyer cutting one check to the seller as proceeds as part of the agreement, buyer and seller agree to those sale proceeds being paid by the buyer to the seller in installments. So very straightforward, part of the agreement, and can be, enacted that way. From the seller side, the real advantage for most sellers is that they then have a periodic receipt and tax recognition of the proceeds or any gains on the proceeds of that sale, because it's coming in installments, as opposed to full tax recognition on one lump sum payment. Okay, that's a standard traditional, point A to point B equals C installment sale. A structured installment sale involves a third party. So buyer and seller still go through the same negotiation process, come to an agreement, price, details. They also agree on some type of installment method for the sale proceeds going to the seller. But instead of the buyer being responsible to make good on those installment payments, and frankly, the seller, fingers crossed in some cases, hoping that the buyer is around long enough to make good on the totality of those installment payments, the buyer assigns the sale proceeds and responsibility for making that installment income design payment stream to the seller to a third party. In most cases, in our world, it's an annuity company or an insurance company that's going to issue an annuity contract that's going to guarantee that income stream to the seller. So it's a slightly different, one extra piece, but the mechanics of an installment sale are there. The one notable difference being is now the seller's not waiting to get a check each month or each quarter or each year from the buyer. They know that the buyer's out of it. They paid the proceeds to an annuity company who's then now making and guaranteeing the fulfillment of that installment agreement to the seller.
Is there a lot of flexibility on how the installments are set up? For instance, could you say I'd like to wait a year or two before I start getting my payments, or can you say I want my payments over 5 years, I want them over 20 years? I mean, is it wide open?
Yes, there's a lot of flexibility and I'll reference this, inside talk jargon a little bit, the income design. However, the seller desires to have the sale proceeds paid to them. So for example, maybe they don't want any of the proceeds this year. They're going to defer 12 months and then begin an annual installment distribution for the next 10 years. That's entirely doable. And to kind of give you an idea of the flexibility here from the seller's standpoint is the seller's life expectancy kind of comes into play as far as if we think of the potential timeline of how long the seller could choose to defer and then receive those distributions. We kind of utilize the client's life expectancy. So a 40-year-old got a much longer potential tail as far as deferring and receiving future income, a 60-year-old slightly less, 70-year-old, so on and so forth. So we kind of look at it from that standpoint, from the outsider, the length, and then to shorten it up.
Yeah.
Again, section 453 says, as long as the seller is receiving at least one payment in a future year, so sale closes this year, long as they receive at least one payment next year, the installment sale provisions can apply. We don't see that too often. We usually see, situations where even in a shorter term payout, maybe spreading out the payments over a 4 or 5 or 6 year period of time. The key being seller doesn't want to recognize the totality of the tax that's going to be recognized on the completion of the sale.
Yeah, so the tax savings with that could be really large. I mean, I would think you could probably cut your capital gains tax in half or so, but what's the cost of it? So obviously they're not going to get as much sales proceeds as they would if they just got a check on a pre-tax basis.
It depends on the income design. I could show you a number of examples where over the course of a 6 or 8 year or 10-year payout, net, the client comes out ahead from the standpoint of not only what they received, but then net of whatever future tax liability they had on those installment payments, because that's how they're going to pay. That's how they're going to recognize cap gains and ordinary income is on the totality of the distributions in each tax year at their rate in effect at the time.
Yeah.
So what's the buyer's role in this? How do they view it? What's their role?
Good question, and it kind of pivots back to what we began with is, buyer and seller kind of having the information, or at least the concept in their minds, because we don't want surprises on either side. From the buyer's perspective, the buyer's agreeing to X amount of dollars for Y property or business, whether they, in their minds, whether they just stroke a single check to the buyer or the seller, or a structured installment sale, to them, it really doesn't make any difference. The number is the number.
Got it.
But there are situations where buyer and buyer's representatives, consider this, okay, the seller is getting potential tax benefits by doing it. We get why the seller wants to do it. What's in it for us as the buyer? Sometimes that falls into the negotiation process of what otherwise might have been a $5 million transaction, maybe now is 4.6 or 4.7, because buyer realizes there's value. Seller obviously knows there's value in a structured installment sale for them. Maybe now the buyer kind of leverages that from their standpoint as negotiation for what that ultimate number happens to be. The other part of it from a buyer's perspective is again, if you recall that the traditional installment sale, the buyer's on the hook for the installment payments. So if the buyer's going to agree to that, maybe it makes more sense, pick whatever reason the buyer may choose to do it from the standpoint of, okay, so I'm sending the $4.7 million to XYZ insurance company, who's now responsible for making the payments. I'm out of it. I own the property, I own the business. I'm not, having to make sure that, I'm fulfilling my duties as the buyer in that settlement agreement, or that installment sale agreement, because I have that third party that's doing it for me.
What if the buyer defaults on his payment?
In a traditional installment sale, the seller's got a problem.
Right.
In a structured installment sale, it's not going to happen because the buyer has stroked one check for whatever amount the seller has chosen to defer via the structured installment sale. So there's, at that point, once it goes to the insurance company who issues the contract for the future income payment, there's no default. I mean, barring, insurance company failure or whatnot, the buyer's out of it at that point. They remain in it in a traditional installment sale.
Yeah, hey, Steve, really, a structured installment sale is only going to be a solution when an installment sale is not the only option
Correct.
for a buyer. True or false? You understand what I'm saying?
I think it's true, because we have yet to encounter a situation where the sale, it was an all or nothing. In other words, the entirety of the sale proceeds went to a structured installment sale. There was always a proportional allocation of sale proceeds that the seller desired. I'll give you just a generic example. Same $5 million sale. Seller wants to defer some of the proceeds, but they want $1 million now to go do whatever they're going to do, reinvest or what have you. So the way the sale agreement, the installment agreement portion of the purchase and sale agreement, and then the execution goes is 1 million at the time of closing goes directly to the seller. The 4 million went via the third party assignment company, the insurance company, to purchase the annuity vehicle that's going to generate the future income on the 4 million.
Yeah, okay, so that's good, but that's actually different than what I was getting at. Let me give you an example.
Okay.
Insider sale, and which we of course get involved with, and the insiders, the company's, let's say it's valued at 5 million. The insiders do not have the money to buy the company, and they actually can't borrow enough money. And so there's going to be two phases. There'll be a phase one where there actually is an installment sale. And then phase two would be where they're going to go borrow the balance.
Mm-hmm.
The phase one during the forced installment sale, because that's the only option. They don't have a lump sum. They can't get a lump sum from anywhere. So they have to do an installment sale in phase one. A structured installment sale is not an option in phase one.
That's correct.
It has to be, the buyer has to access, be able to access a lump sum to then send to the insurance company to then structure the payments, right?
Correct. So in your example, phase two, we can help with.
Right. Phase two, you can help. Phase one, you can.
Phase one, that's not going to work because again, in order to fund and then complete the installment sale, the structured installment sale piece of it is it's a single lump sum from buyer to the third party. So in your example, you're right. Phase one would be a traditional installment sale between buyer and seller. Phase two is where we could come in and help with a structured installment sale. For whatever portion of that, that lump sum that's coming in phase two.
Yep.
In that case, then even if there's an earnout, it can only be the value of that initial payment, and any earnout that happens over the next 2-3 years is, off the table in this structure, right?
Depending on how the contract is written, because we have had situations in earnout situations where, maybe there's a phase 1, 2, and maybe there was a 3 and a 4, that depending on how the purchase and sale was written, that we may have an opportunity even in phases 3 and 4, when the final, true ups or, the final payments, based on earnouts are made, that can be structured at that point.
Okay.
We leave all that to the attorneys, but I mean, as a concept, as a potential solution, it's certainly worth considering.
Very good.
Yeah, and I think you mentioned this a minute or two, Steve, but just want to draw it out to make sure it's clear. The seller does not have to defer 100% of the sale proceeds in a structured installment sale. You want to talk about that a little bit?
They do not. And I just, I jumped to one of my ideas there in answering your question, Pat, but we commonly have situations where the seller, wants to do a couple of different things with the sale proceeds. Defer, structure installment sale a portion, maybe take a portion in a current lump sum, for whatever uses. So from our standpoint, not only do we have flexibility in the ultimate design, how the money is going to be distributed back to the seller over future years, but the amounts, we have some flexibility with as well. The only proviso on the minimum side is, as a general rule, $500,000 is the minimal amount that can be allocated to a structured installment sale transaction. And that's not the government saying it, that's the insurance companies that are offering products in that marketplace.
Yeah, and there's an implication here that the financial advisor of the seller needs to have done a pretty thorough job in out year planning, right?
Yes. Because what we're dealing with again in many of situations that we've encountered is there's a combination goal. One is tax control, how our taxes can be recognized as proceeds. But then the second factor that often comes in is from an income planning standpoint, future income planning. Because if you think about it intuitively from the standpoint of, okay, that $5 million this year, tax bomb, boom. But even if we spread out that 5 million over the next 10 years, how does that income coming in potentially affect, is that going to bump them up rate wise or other from in an income planning standpoint moving forward? So financial advisors are critical in evaluating, providing the client with information. We do a lot of option A through in some occasions option Z, as far as how do we best find that sweet spot for that future income stream to make sure we're not creating future problems for the client down the road. We took care of them now, but is there any potential landmines down the road for us from an income planning standpoint?
Yeah, because I would assume, once the trigger has been pulled, the seller's kind of locked into.
Yes. And that's a key point, Corby, is this is a set and forget type of mindset that the seller has to have for this transaction. On the design and implementation side, a lot of flexibility in how we set it up. But once it's put in place, and go back to one of my examples, deferring distributions for a year and then 10 years of annual distributions, that's exactly how the money is going to come out to the seller. The last thing we want to have happen is that, and certainly from the IRS viewpoint, is the contract was set up, the installment agreement was put in place. Any deviation, changes, adjustments, reductions, to it is going to create a potential, IRS close look, followed by maybe some dollars flowing out that you didn't want because you tried to change what was put in place within the guidelines of Section 453.
Steve, let me ask you one question. Sorry, Corby.
No, go.
So if you do, you're doing a traditional installment sale, you take back a note, you receive principal and interest. The principal, obviously, you're taxed at capital gain rates. The interest is ordinary income.
Mm-hmm.
Is it similar in this situation that the payments they're going to receive from the structured settlement, some of it are proceeds from the original sale, and there's also a component that's interest or some type of investment earnings?
Yes, and the gross profit percentage. So when the proceeds, everything's calculated at the time of the sale, and we know things like, okay, what is the profit in here? Sale price less, adjustments, net, what would the client be profiting on the transaction? That percentage applies and would be applied in each year that those future year distributions were coming out. So for example, if this was really a low cost basis transaction, so let's say it was an 80% profit margin on the original sale, money's allocated to a structured installment sale. When money is paid out each year, that 80% would be applied to, the amount that shows up on the 1099 from the annuity company each year, which would be, 80% basically profit, 20% return of basis. And that's how you folks in your profession would calculate, again, within the confines of 453, how you broke up the distributions for each of those tax years.
Got it.
Yeah, that makes sense.
So Steve, folks listening are probably thinking, okay, this sounds great. And like it might be a solution for my situation. I very much have a core value of minimizing taxes. But the next logical question is, how much is it going to cost me in order to make it happen? So what are the general fees that someone who puts this in place can expect?
Yeah, the fees and we've been talking today mostly about, annuity solutions, either a fixed annuity or we have one insurance company in the marketplace that offers a fixed indexed annuity as the product or the mechanism to generate the income. The fees vary by the product type. So for guaranteed annuities, 100% guarantee, to the penny what you're going to receive when you're going to receive it. There's generally a one-time fee at the time the contract is set up. It's called an assignment fee. Round numbers, $500, $750, one-time fee that is deducted from whatever sale proceeds amount are being deferred. Other than that, there's no ongoing charges, fees, expenses that the client is paying once the contract is put in force. One potential solution we have not talked about yet is using a trust, installment sale trust, where instead of utilizing an annuity contract as the distribution mechanism, a trust is set up, proceeds are put into the trust, and then based on the predetermined income design that's placed as part of the trust provisions, the money's then coming out, at that same time, but now the trust may be invested and managed by a financial advisor in a managed account based on the client's risk reward tolerance, where then now you have a variable distribution income coming out, but at a predetermined basis and systematically on a predetermined basis, but the value of each of those distributions is going to be based on the performance of the underlying managed account.
Yeah, the managed account would be managed by their financial advisor.
Correct. And where I'm going with this is from a cost standpoint, then instead of a one-time assignment fee, and now it's the annuity company's, responsibility from that point forward, utilizing a trust. Of course, there's setup, administration, ongoing for the trust itself, and then there would be an investment management component that the client would be paying for their advisor or some other firm to be managing the assets within the trust. So two different and distinct expense and fee type structures based on the solution that the client desires for that installment sale.
Mhm.
And we can help with all of them.
Okay. All right, good. What should we have asked that we haven't asked?
I think buyer and seller, we covered that at the outset. That's something that does trip up the completion of a structured installment sale. I do believe, and we talked briefly about it from the buyer's perspective, there are reasons why a buyer is incentivized by completing, agreeing to and participating in a structured installment sale. It's usually led by a seller because it's been pointed out to the seller, the tax advantages or income planning. But I think from a buyer's perspective, you can make a valid case and proposal that it makes sense for the buyer from that standpoint.
What and just give a couple of reasons for that, if you would.
From the buyer's perspective,
Yeah.
I think the negotiation part of it, if the buyer can maybe save a few dollars because again, they're writing a check, one direction or another, doesn't matter to them really on balance, that maybe they can negotiate a slightly better purchase price because of the fact they're agreeing to the addition of that structured installment addendum to the contract. There are cases where maybe looking at a traditional installment sale where the buyer is going to stay in it. Maybe they like the fact that, okay, I as the buyer just wrote a $5 million check. Now, that affects, my tax return for this year in buying it, as opposed to something that maybe I'm doing based on the installment agreement that we put in place, where now I'm having to wait each year to file on my taxes. So those are just two examples, but sometimes what we have found, kind of learning from past mistakes or missteps, or we should have covered that earlier, is the more these types of ideas and potential outcomes on both seller and buyer side streamlines that process, where once we get to, okay, we've got the number, we've got a close date, away we go. We don't want anything upsetting that from point of agreement to actual close and funding.
Mhm.
Excellent.
Yeah.
Good. Corey, Walter, any last? questions?
Yeah, this has been great.
Mhm.
Steve, thanks so much for joining us. Is there anything else, anything you're like promoting today? And can you tell our listeners how they can get in contact with you?
Yeah, not promoting any in general, other than for clients, for business owners, for real estate developers, even folks maybe that have been historically 1031 exchange type of mindset. A structured installment sale may be a potentially valuable solution, whether you are selling or whether you're on the buyer side. From a contact standpoint, the best way to reach me is a couple different ways. My Ash Brokerage email address, which is steve.pilger@ashbrokerage.com. My direct phone number is area code 260-450-8827. Those are probably the two easiest ways to get a hold of me. Or provide you, again, background information. Again, there is settled law and rules and regulations on the books, talking about installment sales. A good part of what I do upfront is very simply, from an education standpoint, buyers, sellers, their centers of influence. Everybody's got to be comfortable, and the buy off needs to be before any money changes hands, because as we all talked about here a couple of minutes ago, once one of these transactions is completed and put in place, we're not changing things. We're not,
Right.
throwing up the pause sign and making changes. So we need to make sure, from an education, from a design and implementation standpoint, that everybody's on board.
Yeah. Thank you very much. Really appreciate it.
It's my pleasure, gentlemen.
Mhm.
Listeners, if this conversation has piqued your interest, please feel free to reach out to Steve. And if you need help in building a transferable business or planning for your exit, you can reach either Pat or me or Corby through our websites, grfcpa.com and ennislp.com. Until next time on the Exit Readiness podcast, this is Walter Dial and Pat Ennis signing off.